Hi guys, this is James with the Investor Mortgage Insider. Today I want to talk to you about the property investment strategy that most banks don't want you to know. And this is the exact strategy that I've helped hundreds of investors fund deals for cash flowing properties. It's by using DSCR loans. Now you might be asking yourself, what even is a DSCR loan? First off, DSCR stands for debt service coverage ratio. So the best way to think about it with debt service coverage ratio is just if the property cash flows, the lender will do the loan. What I mean by that is as long as the rent on the property or the projected rent on the property, whether that be for a long-term rent or a short-term rent, is enough to cover the payment for the property, the principal, interest, taxes, and insurance, then the lender will do the loan. No income taxes for you, no personal documentation in terms of your W-2s, your tax returns, your pay stubs, nothing like that. If you're self-employed, you don't have to provide a bunch of bank statements to show your income. At the end of the day, for DSCR loans, the beauty is, can the property cash flow? The lenders will do the loan. So let's give you an example here. Let's say that the property is getting $2,000 a month in rent, and the full payment, principal, interest, taxes, insurance is say $1,600. Well, that means you're cash flowing by $400. Well, the way we figure out like the DSCR ratio is we take that $2,000 and we divide it by the $1,600, and that would give us like a DSCR ratio of 1.25. Now, the reality is that most lenders actually don't even need that high of a DSCR ratio. If you have that, great. Some lenders will give you a little bit better pricing to have a DSCR ratio of 1.25 or higher, but most lenders just want you to have a DSCR ratio of 1, meaning the property just has to cash flow by $1. As an example, $2,000 a month in rent, the total payment is $1,999. That $1 difference is all we need to get you property qualified, allow you to utilize a DSCR ratio. So no reason to overcomplicate the DSCR number, like is it 1.0, 1.1, 1.25? Don't worry about that. Just focus on, does your property cash flow? Yes or no? Lender will do the loan. So the main benefit for this type of loan is going to be that you don't have to use tax returns or your personal income qualifications at all. If you're a business owner, we don't have to pull P&Ls or bank statements or anything like that. Even if you're an engineer or a doctor or a lawyer or something like that, you make really good income, but then you're writing all these things off because your investment properties that you have, we don't have to dig into that. At the end of the day, the lender's looking at one thing, that one asset. Is it enough to cover the payment? Great, then we're gonna do the loan. So it's really for anybody who has investment properties, definitely for people who are self-employed, definitely people who maybe even inherited a property and they just inherited this property and they don't have enough income to qualify if it was included to their debt to income ratio, but they do have enough because we know the property is going to qualify on its own, then we're good to go. So once again, the minimum DSCR ratio that most lenders want you to qualify with is a 1, meaning you have to qualify by $1. Now that doesn't mean that you can't qualify with less. There are lenders who offer DSCR ratios under 1, meaning that the property doesn't cash flow. Some lenders will go from like a 0.75 to 1. Some even have what's called a no ratio DSCR loan. Now, of course, common sense would tell you that those rates and costs are gonna be worse than a property that is cash flowing, right? The property's not cash flowing, that means money is coming out of your pocket, so it's more risk for the lender, right? So because of that, they're gonna change their pricing accordingly. They're gonna end up going ahead and making it a higher rate, a lot of times a lot higher of a rate. You also typically will need a higher credit score to qualify. You're also gonna need maybe a lower leverage to qualify if you're under 1. So these are things that, once again, we try to structure the deals so that the property just cash flow by $1. So if you take a step back, DSCR ratios really aren't that much different than conventional loans. At the end of the day, even on a lot of the paperwork when you're signing documents, it says a 30-year conventional mortgage or even a 40-year conventional mortgage. The main differences between the two, realistically, is obviously you are essentially trading in the rental income of that property for your tax returns. And the lender is basically saying, hey, let's go with just the lease, but in exchange for that trade, they're gonna get a 3-year prepayment penalty, meaning you have to hold on to the property for 3 years. So it's not the end of the world. I would say 80 to 85% of my clients take a 3-year. You can change it to like a 1-year prepayment penalty if you wanna go shorter, which is probably the rest of my clients, they'll go with a 1 year. Some lenders push and sell 5 years. I obviously can, but I don't promote it. I've actually never done one. I have some clients have suggested it, but I just don't believe in it. The difference in the pricing is not really that much better to get yourself stuck in a loan for a couple more years. So the other thing that's important in terms of the documentation and what the lenders are looking for, at the end of the day, because they're not looking at the tax returns and they're looking at just this payment, they want to look at your payment history. So essentially they look at your credit score, and making sure your credit is solid, right? Obviously within their range, most of the time, at least a minimum of 620 to obviously as high as you can go. The second thing is that they're going to look at your payment history. Every lender wants to make sure you're at least on time with the subject property as well as your personal residence, right? And that doesn't matter if you own your personal residence or not. If you're leasing or renting an apartment, as an example, or renting a house, they're going to verify that you made your rent payments or you made your lease payments for that house for the last 12 months. Some lenders will qualify just on those two things, the subject property and your primary residence. Some lenders will qualify literally everything that's on your credit report. So if you have 10 properties on your credit report, they're going to verify typically through the credit report that you're making your payments on time. And if you are, great, no problems. Now, the only thing is, if you're late one time in the last 12 months, no big deal. They kind of give you, everybody allows you to have one oopsies, so to speak. Hey, my automatic payment turned off. Hey, something happened here. If you go over one and you have two multiple 30-day late payments in the last 12 months, and that could be one for one property and one for another property, kills your loan with 99% of DSCR lenders out there. Now, I was actually talking to one, funny enough, yesterday, a lender who does offer multiple 30-day lates. They said unlimited, which I'm going to dig a little bit more into that to verify. But most of the time, these lenders are selling these loans to investors on the back end, and these investors want to make sure you're making your payments on time. And so usually you want to make sure your payments are on time. So do your best in that case, but that would be the main differences between the DSCR and the conventional option. So in this section, obviously, we want to talk about why banks and other lenders don't talk to you about these loans and why it's kind of a niche when it comes to mortgages. The main reason, I think the most common sense reason, is that not everybody does everything, right? And there's a reason for that, right? If you think about fast food as an example, Taco Bell doesn't sell burgers and McDonald's doesn't sell tacos, right? There's a reason why they need to build a brand of this is what we offer so people can know what to expect when they get there. The point being is that they have to focus on what they're good at. And so a lot of times, say like Rocket Mortgage is the #1 lender in the country, meaning they do more loans than everybody else. Well, what do? Conventional, FHA, VA, right? Which is great because they do that and know that so well. They can, these things churn out. It's awesome. I do conventional loans with Rocket Mortgage all the time, and it's a great experience for me and my clients most of the time, probably a high percentage of the time. They don't go and offer these DSCR loans. On the other hand, there are brokers and other people, other lenders who do offer these products, but sometimes these brokers and lenders are not going to bring up a DSCR loan. And the reason why is because they really don't understand them. The most important thing is you want to deal with a professional, somebody like myself who really understands these at a high level. This represents over 80% of my business. I look at last year, I did like 83 loans, and this year we're on our way to like around 100. Majority of those are DSCR with a few other loans mixed in. So what does that do for me? It allows me to go and get experience and understand these loans where other lenders can't. Let's talk about who offers these. There's a bunch of what are called non-QM lenders out there that offer these type of loans. A lot of them are not big brand names, like you're not going to be a household name. There's also some direct lenders, that's all they do. Some credit unions will offer these. The big thing though to understand is these aren't small companies, a lot of them. Some of them are, obviously, right? But some of these are backed by major hedge funds that are basically, these lenders are doing these loans and then selling them off to a lender on the back end, and these lenders on the back end are typically big boy hedge funds. Like people have a stupid amount of money that they're going to go and buy these loans and service them, right? And they like them because their fallout rate is very low. Most of the time, the reason why is because if the lenders can prove that the property can cash flow, well, the lender knows the person's going to have the money. So their odds of defaulting and not paying are pretty low, right? Great product for the investors on the back end, great product obviously for you. So let me give you a couple different examples of clients that we helped out recently through a DSCR loan. I think the first one that definitely comes to my mind is a client that he actually could qualify for a conventional loan. Most of his properties were paid off. His debt to income ratio was low. He made good money, right? But after talking about conventional loans for like months, he finally got back to me. He's like, James, I don't want to do it. I don't want to do a conventional loan. Do you offer DSCR loans? Which I thought was funny because I'm like the DSCR guy. Like I do mainly DSCR loans, and pretty sure I brought it up to him, but neither here nor there. Anyway, so I was like, yeah, I offer DSCR loans. And the reason he wanted to do it, that he expressed to me that he's like, I don't want to do conventional loans. He's like, I don't want to go through that process. I do not want to have to provide tax returns. I don't want to provide mortgage statements. I don't want to have to provide homeowners insurance policy for every property. I don't want to go through this process of figuring out the debt to income ratio and everything else that comes with a conventional loan. I'd rather just go to DSCR loan. I know my fourplex can qualify. The rent can cover the payment. We'll be good. Another example, I had a lady a few months ago. I talked to her. She said, I just inherited this property. I'm going through this process of getting it in my name. So we just kept on talking. Finally, about 6 months later, she hits me back up. She's like, James, we're good to go. I want to pull cash out. She was already turned down multiple times to do a conventional loan. She couldn't qualify. because she was older. So, and in this case, all she had was Social Security and I think a little bit of retirement income. And she had inherited this $1.5 million property. So without a DSCR ratio, if she wanted access to the cash from that property, she would have had to sell the property. How sad is that? Instead, because of the DSCR ratio, she was able to keep the property that she inherited from her family. Amazing. She was able to pull $400,000 cash out of a $1.5 million condo in California. It's crazy, $1.5 million for a condo. Anyways, regardless. So she was able to pull some of her inheritance and benefit from that and get to see some of that cash and experience that, which is great, right? At the same time, she could qualify no problem because we could prove that that property was rent out, for like $6,000 to $7,000 a month. So this $6,000 to $7,000 a month in cash flow was more than enough to cover the payment of the property, so it was a no-brainer on the loan. Also, she got good terms on the loan because she had low leverage. So it was actually one of my easiest loans I've done all year. The other one, and this is probably the most common one, is that people also just can't qualify in general. I have self-employed people and other investors who typically, you guys are writing off a lot, as you should be. However, you're getting penalized for that. This client recently, because they had multiple investment properties, there was no way for them to qualify for a conventional loan. Before they even got to me, they'd already been told no 2 or 3 times, which then they see my ad, we talk about it, and we see that the DSCR loan works no problem. And so next thing you know, they're not having to worry about the DTI issues anymore. They have a property that cash flows. We were able to get a loan for them. They were able to pull 75% cash out of the property. Think about this. They couldn't qualify for a conventional loan. And now they're pulling max leverage out of an investment property. Amazing, right? All through a DSCR loan. And this is exactly what I do. I help investors grow their portfolios and make moves. And if you are interested in doing that for yourself, feel free to click on the link down in the description below. Jump on my calendar, let's have a conversation. I've helped hundreds of investors make these moves and grow their portfolios. I've educated probably at this point thousands, because a lot of people are not necessarily in a position always to make a move, but I get on the phone with them, I walk them through the process. I'll do that with you. I'm not gonna charge you anything to have a conversation with me. You walk me through your scenario, I walk you through on the options that are available to you. If it makes sense, great. Love to do business with you. You'll have a guy like me you can trust that's gonna take care of you at a high level. It's not just me, it's my team, and we love to make sure we get these loans done for people. But I take great pride in making sure I'm taking care of somebody the way that they would like to be taken care of, like the way I would like to be taken care of. So now that you understand DSCR loans and what they are and essentially how they work, let's talk about how you can utilize them to make your next move, grow your portfolio, and become wealthy through real estate. Let's talk about some of the minimum requirements. I think that's a good starting point, right? So 620 minimum DSCR. I do have a lender that will go down to 580. The terms are nasty. Obviously, the higher your credit score, the better your terms are gonna be. So instead of a 620, if you can get yourself up to at least a 680, that opens up the doors to 75% cash out. If you get to 700, I think that's a good number for everybody to shoot for. And the reason why is because once you get to 700, there is not a lender out there that will not allow you to get 75% cash out at 700. I can already hear people asking, well, what about 80% cash out? There are lenders who will do 80% cash out. They typically require a 720 or higher credit score. The number of lenders who do that is very limited. I'm down to like 2 out of 150 plus lenders that we do business with. And one of them is really good at it, but even then they have certain restrictions around it. So I would say shoot for 700. If you can get obviously higher, the better those terms are gonna be. Even if you don't want 80% cash out, if you get yourself a 760 credit score versus a 700 credit score, you're gonna get yourself better rates or better costs for the same rates. One other minimum thing that we probably should talk about is loan amounts. Typically, 100,000 is a good number. Realistically, the number is 75. I've got lenders who will go down as low as 75,000. I think the key number to really look for is a value of 100 grand. Try to shoot for $100,000 loan amounts. Typically that means that you're gonna need a value of at least 135-ish, okay? And so that would be the number that I would say is a minimum. When we talk about purchases, the minimum down payment for most lenders is 20%. There are some lenders who flirt with 15%. My experience is those lenders typically need at least a 720 credit score in order to do that. Also, the terms are they're not great. Obviously, the lower the leverage that you have, the better the terms that the lender is going to provide you because the less risk that you're providing. Also, in this market that we're in order to cash flow these properties, you have to have lower leverage because the rates are in a certain spot where it's just a requirement to get the numbers to pencil out. Since we're on the topic of purchases, I think it's important for you to know a couple different things. One, you don't actually need all these different things. You don't own the property, so there is no lease. So all you're literally bringing to the table is your proof of your down payment, okay? which you're 20% down. You need to have reserves. So typically it's 3 months of reserves. What I mean by that is the principal, interest, taxes, insurance, and if there's an HOA, make sure you include that. 3 months of that. And then you need the closing costs. And something to throw out there about closing costs, obviously those are going to depend based on what county and state you're in for title and fees. It's also going to depend, underwriting and stuff like that's going to be dictated by the lender. But most of the time lenders are anywhere between say $1,500 to $2,000 depending on the lender. And a lot of times if they're a little bit higher, they will mix in some of the other costs into that. So it's just one overarching fee. Points is something that's going to be dictated by the rate you choose most of the time. So ultimately, you can kind of control that. And if you're speaking to somebody and they aren't giving you that many options, ask them why and see if you can get you some options with some lower costs, if possible. Sometimes it's not with these DSCR loans. It's just where things are at. But the point being, with the closing costs on this market that we're in, if you're in a deal and it's not like a heavily competitive property that a bunch of people are trying to buy, you should try to get the sellers to cover your closing costs. Like, it's a no-brainer to me. Have them cover your closing costs, get yourself the lowest rate that you can possible, get you a lower payment, you benefit. So these are just little things to keep in mind when you're going to purchase a property. In regards to the rental income, how they determine what the rental income is, it's one of two things. If you own the property already, then you have a lease, right? So, or it's vacant, one of the two. But if you have a lease, that lease is going to help us dictate what you can qualify for. Once again, go back to my example in the beginning of the video, which is like, if you're getting $2,000 a month in rent and we can prove that the payment's going to be $1,600, you're good. Don't even worry about it. The other thing that they qualify you with is the market rent. And market rent would be for purchases and for cash out refinance or refinances in general. And the way they figure out the market rent is when we do an appraisal, we do what's something called like 1004. That's a standard appraisal. And then we also do a 1007. The 1007 is basically the market rent analysis. They figure out other properties that are similar to yours. What are in the market? What are they renting out for? They'll pull 3 of them and that will dictate your number. So that's why I always ask clients, what is the market rent? And most lenders, they will take your lease and they'll take your market rent and they'll take the lower number of the two. So let's go back to my example. You're getting $2,000 a month, but the market rent's $1,500. Somehow you're getting $500 above market rent. The payment's $1,600. Well, now you don't qualify, right? So that's why we have to kind of know what that market rent's going to be. Now, there's other rules and things to get around that. Even with that, if you can prove, a lot of these lenders, if they take the lower number, what they'll end up doing is taking, say, that $2,000 and say, hey, if you can prove to us for like 2 or 3 months, sometimes it's 1 even, we'll take the market rent, increase it by as much as 25%. So this is like a little thing to know so we can make these type of moves. But the other option is the lender will take the higher number, which I try to use lenders as much as I can who will take the higher number, especially if we need it. We'll go back to my one client. I have a client that she was a nice lady. She was renting her house out for $900 a month. Now the issue was that the market rent was $1,700 a month. She's charging $900. So what do? We have to go to a lender who's going to take the higher number of the two. So in this case, the market rent. And that now most lenders don't do that. So that's why you kind of have to talk to a professional and they need to understand the scenario. They need to ask you this question about what the market rent versus what your thing is, because that's going to ultimately dictate your loan. Like, that's going to dictate whether you qualify or not. And instead of figuring out down the line after the appraisal comes back, oh shoot, we're in trouble here. You're not going to qualify, or we're going to have to cancel and move this loan to somebody else. These things could be figured out up front. Going back to the purchase, how do you know if it's good for DSCR? You just got to do a little bit of due diligence, right? I would team up with reach out to a realtor. I would find out from a realtor, what is the market rent or the expected rent for a property. There's website, obviously Zillow kind of gives you a good rent estimate. There's Rental Meter. Rental Meter is a great tool. Once again, these are not always right. And so that's why also speaking to a professional realtor in the area and finding out what the rents are for that type of property to expect is really good, because then you can just start working backwards. You find out what the rent is, you find out what the taxes and insurance are going to be. Speak like to somebody like myself who's going to give you the information for what the projected payment's going to be, and you work backwards. Rent minus taxes minus insurance minus payment. Do we have a positive number? We're good. So it's really not that complicated when figuring out if a property is good or not. The properties I would tell you right now that are really tough at times are properties who have really high values, because people in the West Coast, California is a great example, or any of the metroplexes, Dallas, Miami, New York, whatever. The issue is that the values are so high, the loan amounts are so high. In some of these markets, they can only charge people so much in rent. And if that's the case, then it makes it hard for properties to cash flow. The other thing is condos or even single family homes that have HOAs. Man, HOAs are where DSCR loans go to die. I mean, there's so many condos where like after the client pays for the HOA, the taxes and insurance, there's literally no room available for the payments. So make sure that if you're doing a condo or you have a property that has an HOA, make sure you figure that out into your calculations. And if you do know that when you're talking to your loan officer, like me, make sure that they know that, right? So that they can help you figure that out as well. So do I think that you should do a DSCR loan? Absolutely. I've done DSCR loans. I've done bank statement loans. I've done a ton of conventional VA, FHA. I've done asset utilization loans, bridge loans, fix and flip loans, you name it, right? And the one loan that opens the door to the most people possible is DSCR. Literally. I don't care what your income is, what your background is, you're an investor or you're self-employed, did you just inherit a property? It doesn't matter. If you can prove that this property can cash flow, the lenders will do the loan. How awesome is that? What I learned after doing hundreds of these loans and getting kicked in the teeth and having to work through my clients and do all these things and going through this painful process sometimes with these lenders is I learned what are the top lenders to go through, who do I have good relationships with, which is going to help me get these loans to the finish line better. But more importantly, I learned all these rules and guidelines. I learned them all. Right? And I understand them at a high level. And so because of that, now I have a submission checklist sheet that I go through myself as I'm talking to the client in my mind. And then I have my assistant back me up. And that before we submit the loan, she goes through every single one of them with you to make sure that we create a package. We're going to provide the lender with something that's going to fund. Right? We're going to control as much as we can control up front. And then if things come up in the back end, which happens for a majority of your loans, no matter how perfect you think your financial situation is, there's always something, it feels like. Well, guess what? We can battle those. We can handle those, no problem. But the problem is when you have a storm of a bunch of different problems where loans go to die. Hopefully you learned something in this video, but if you want to actually get into your scenario, click on the link in the description below. Jump on my calendar. Go over. I'm not going to charge you anything to speak with me, okay? I've spoken to thousands of people, given free advice to hundreds of people. I get a consistent theme that I get from people is, James, you are very helpful. You're more in depth, you understand this at a high level. I appreciate all the information that you gave me for free. Hopefully you'll want to do business with me because you can see that we're professionals, we get things done, we take care of our clients. But at least take some time in the day if you're serious about being an investor, you have a property, maybe you're trying to buy a property, jump on my calendar, let's go through it together. I'm going to keep putting out more of this content, making sure people get educated on these things so they can continue to grow their portfolios. I'll see you on the next video.